If you study the biggest market collapses of the past century, an uncomfortable truth starts to emerge. They don't just rhyme, they repeat. The crashes of 1929, 1987, 2000, and 2008 all unfolded through the same sequence of events, not roughly similar, structurally identical. This sequence begins long before headlines turn red, sometimes years earlier. Wall Street understands it, central banks understand it. The institutions managing generational wealth understand it. Most people never hear about it for one simple reason. If the public recognized the warning signs early, they would exit before the damage instead of absorbing it afterward. What follows are the 5 stages that quietly precede every major financial collapse, and where we stand inside that cycle today. And the uncomfortable part? We are far closer to the end than most people realize. In the late 1920s, a financial analyst named Roger Babson stood before a room full of business leaders and said something that instantly turned him into a pariah. He warned that a devastating market crash was inevitable. The audience laughed. Newspapers ridiculed him. Irving Fisher, arguably the most respected economist of the era, publicly dismissed the idea, insisting stocks had reached a permanently elevated level. Less than 2 months later, the market imploded. Fisher lost his fortune and never recovered. Babson didn't just survive, he prospered. What history rarely mentions is that Babson wasn't making a guess. He followed a disciplined framework built around 5 measurable conditions: credit expansion, market concentration, institutional behavior, liquidity stress, and structural fragility. I spent months reviewing historical data, Federal Reserve records, and academic research to see if his framework held up beyond 1929. It does. Every single time. The first stage is always a surge in credit. Crashes don't begin with panic or greed. They begin with debt. Before every collapse, borrowing grows faster than the real economy. Easy money fuels asset purchases. Rising prices create the illusion of wealth. That illusion encourages even more borrowing. It feels like prosperity. In reality, it's leverage quietly tightening its grip. In the 1920s, ordinary Americans borrowed nearly everything to speculate in stocks. By the time the market peaked, margin debt rivaled the federal budget itself. In 2008, leverage hid inside housing finance. Mortgages were issued without income verification, bundled into complex securities, and sold as low-risk investments. In 2000, corporations borrowed heavily against inflated stock prices. When valuations collapsed, the debt structure disintegrated with them. Today, the scale is larger than ever. Official margin debt numbers barely scratch the surface. Add portfolio-backed loans used by wealthy investors. Add derivatives exposure where small capital controls massive positions. Add corporate debt exceeding $10 trillion, much of it used not for growth, but for stock buybacks. Add government debt that now requires more interest payments than national defense spending. Relative to economic output, total debt today exceeds levels seen before both the Great Depression and the global financial crisis. Stage 1 isn't forming, it's already entrenched. Stage 2 is concentration. Markets don't collapse simply because prices are high. They collapse because risk becomes centralized. When a small group of assets dominates market value, the system loses resilience. One failure spreads everywhere. In 1929, a handful of glamour stocks carried the market. In 2000, technology giants defined the entire index. And in 2008, systemic risk hid inside a few interconnected banks. Today, concentration is impossible to ignore. A small cluster of mega-cap technology companies now represents a historically extreme share of market capitalization. Passive investing amplifies the effect. Money flows automatically into the largest stocks, reinforcing their dominance. This creates momentum on the way up and forced selling on the way down. Diversification becomes an illusion. Stage 2 isn't emerging. It's already stretched to its limit. Stage 3 is the quiet exit. This is where the system reveals its imbalance. Before every major crash, informed participants reduce exposure without warning anyone else. They sell, they hedge, they raise liquidity. Publicly, they express confidence. Privately, they prepare. In 1929, elite families exited months before the crash. In 2007, sophisticated investors shorted housing while selling risk to clients. Today, corporate insiders are selling at levels rarely seen before. Executives with direct visibility into earnings and balance sheets are reducing exposure. At the same time, retail investors are increasing theirs. This imbalance isn't accidental. It's structural. Stage 3 always looks like optimism on the surface and preparation underneath. Stage 4 is the liquidity mirage. Everything still appears stable, markets function, prices remain elevated, but the oxygen is draining. Liquidity allows markets to absorb shocks. When it disappears, prices don't decline, they gap. In 1929, tightening monetary conditions quietly removed support. When selling began, buyers vanished. In 2008, rising rates and tightening credit preceded sudden collapse. Today, interest rates have risen at the fastest pace in decades. Central banks are withdrawing liquidity while claiming stability has been restored. Yet stress fractures are visible. Bank failures, emergency lending facilities, and instability in the treasury market. The backbone of global finance. Stage 4 always feels calm. That's what makes it dangerous. Stage 5 is the trigger. The trigger doesn't cause the crash, it reveals it. When leverage is extreme, concentration is high, smart money has exited, and liquidity is thin, any shock can ignite collapse. In 1929, a minor overseas financial scandal set off global panic. In 2008, it was Lehman Brothers. This time, the trigger could come from anywhere: geopolitics, banking stress, sovereign debt, derivatives, or something no one is watching. That's how it always works. When the first 4 stages align, the trigger typically follows within 1 to 2 years. This doesn't mean a crash happens tomorrow. Timing markets is impossible. And it doesn't mean panic is a strategy. It means the conditions that preceded every major collapse of the last century are present again. History doesn't punish ignorance, it punishes complacency. Roger Babson survived because he respected patterns instead of narratives. Others trusted reassurance and paid the price. The question isn't whether markets recover eventually. They always do. The question is whether you're positioned to endure the fall in between. Patterns don't guarantee outcomes, but ignoring them has never ended well. Now you've seen the pattern. What you do next is your decision.